So another interesting point about bubbles and this notion of diversity breakdown is the relationship between what Robert Hagstrom calls fundamentalists versus trend followers. Most of the time, there is an equilibrium between fundamental focused investors and trend followers. When they are in equilibrium, prices are most likely going to be closer to intrinsic value. But as we know from history, bubbles happen pretty regularly. To break down how this happens, we can see that during these events, the equilibrium between fundamentalists and trend followers changes. So let's say there's a stock that fundamentalists like very, very much. The stock has been moving up somewhere around the increases in the intrinsic value of that business. But then, as that stock price goes up, we get more and more trend followers observing the exact same thing. They're liking the fact that the stock price is going up. So they begin to buy the stock and they drive the price upwards. Now the fundamentalists, they start exiting the stock because they're like, okay, well, this stock is good, but the price is getting to a point now where it doesn't make any sense. So a lot of these fundamentalists are going to start exiting the stock and selling it. But they have willing buyers. These momentum people are just going to keep on buying the stock. So this basically results in the fact that you have less fundamentalists and more momentum traders, and the equilibrium goes way out of whack. And this can go on for very, very long periods of time until the momentum eventually stops. So once the momentum stops and the trend followers decide to all exit, you have these massive bubbles that pop, and it's not very good to be a holder during that time. So this is just a good example, and kind of Clay is going to go over some stuff happening with GameStop that aligns really well with this.